Okay, so how exactly do you put a price tag on a $41 billion software giant? I mean, imagine for a second that you're pulling up a chair at a table with some absolute investing legends. We're talking Warren Buffett, Peter Lynch, and Benjamin Graham. You sit down and you slide a thick file across the table, the financials for Roper Technologies. How would these titans of value, growth, and defensive investing actually dissect this company? Well, today we're going to put on our expert investment analyst hats and do exactly that.
Welcome to this explainer, where we're going to rigorously put Roper Technologies through an absolute gauntlet of legendary investing frameworks. And then we'll back all of that up with some modern quantitative models. We're looking way past just the stock ticker today to see what the raw numbers and these timeless philosophies really tell us.
Here is our game plan for today. We'll start with a company snapshot, then apply the Buffett, Lynch, and Graham lenses. After that, we'll run a DCF valuation, and finally, we'll wrap it all up with a synthesis and final verdict.
Let's jump right into Part 1, Company Snapshot, the foundation of Roper Technologies.
So, Roper Technologies, trading on the NASDAQ under the ticker ROP, is currently sitting around $408 a share, and it boasts a massive $41.18 billion market capitalization. But listen, this is not your traditional tech startup. Roper is literally a compounding machine. Their whole playbook is to buy highly profitable niche software businesses, let them run autonomously, and then just use the cash they generate to go out and buy even more. And looking at the breakdown of their revenue brilliantly illustrates how they pull in the cash. For their Q1 2026 results, they posted a massive 11% overall revenue jump, hitting $2.1 billion. And if you break that down, their application software segment is driving the lion's share of that at nearly $1.2 billion, which is followed up by network software and technology-enabled products. Really, what we're looking at here is a highly profitable recurring revenue engine.
Moving on to Part 2, the Buffett lens, moats, management, and margins.
If we slide these financials over to Warren Buffett, he's immediately going to look for a wide economic moat, and Roper definitely has one. They operate in these highly defensible niche software markets where switching costs are painfully high, which gives them incredibly consistent earnings. I mean, Q1 adjusted diluted earnings per share were up 8%. And for owner earnings, which is a metric Buffett absolutely loves, we look at their free cash flow. That was a staggering $562 million in Q1 alone. You annualize that and you're looking at over $2.2 billion in cash generation. But there's a catch. They're carrying $10.6 billion in long-term debt, so Buffett would definitely want to keep a very close eye on their capital allocation.
Now, the real kicker for Buffett is this very solid 11.36% return on equity. The management team, led by CEO Neil Hun, is super shareholder-friendly. They're actively deploying capital into opportunistic share buybacks. We're talking $1.5 billion repurchased in Q1 alone. So Buffett would absolutely love the underlying business mechanics here. But being the strict value investor he is, he demands a margin of safety. He wants to buy a dollar's worth of value for 50 cents, and at $408 a share, he just isn't getting it. Honestly, he'd probably wait for a pretty significant market dip before initiating a position.
All right, let's pivot to Part 3, the Lynch lens, growth categories and Wall Street crowds.
Peter Lynch would look at Roper and likely stamp it as a highly profitable stalwart that's bordering on a fast grower. That's thanks to their aggressive acquisition strategy and consistent double-digit revenue growth. But much like Buffett, he'd question the valuation. Lynch loves the PEG ratio, which is price to earnings divided by growth. With a PE of 16.90 and our projected growth rate, Roper is sitting at a PEG ratio of 1.76. Now, Lynch generally prefers a PEG right around 1.0, so that 1.76 suggests the stock's future growth is kind of already baked into the current price.
But guys, here is the immediate red flag for Lynch. He famously loves undiscovered gems. Roper, however, has a massively crowded institutional ownership at 93.31%. Wall Street already knows all about this stock. The secret is definitely out. And if you contrast that with recent insider activity, well, Director Richard Wallman recently sold $2.3 million worth of stock, and Executive VP John Stepanchik sold over $758,000. So you've got high institutional ownership combined with insiders taking chips off the table? For Lynch, that firmly puts Roper in the hold category.
Next up, Part 4, the Graham lens. Time for the brutal defensive investor check. Benjamin Graham's framework is frankly unforgiving. Now, Roper easily passes his rules for adequate size, incredible earning stability, and an amazing 33-year consecutive dividend record. But it completely fails his strict financial rules. Graham wants a current ratio of at least 2.0, meaning a company has twice as many short-term assets as short-term liabilities. Roper sits at a precarious 0.55. On top of that, Graham demands cheap valuation multiples. Roper's PE of 1690 and price-to-book of 2.1, they're simply way too rich for his defensive criteria.
And if we actually do the math, it gets even worse for Graham. We plug Roper's expected 22.22 earnings per share and roughly 179.90 book value per share into his intrinsic value formula, which is the square root of 22.5 times EPS times book value. What do we get? 299.90. That means to get any sort of margin of safety, Graham would need to see the stock trading well below $300. So at 408, yeah, Graham wouldn't touch the stock with a 10-foot pole.
Let's shift gears to Part 5, DCF and alternative valuations. Let's look at the math behind the software. Okay, so let's hand the data over to the modern Wall Street quants and build our base case discounted cash flow, or DCF model. To fill in the blanks, we're taking Roper's massive Q1 free cash flow of $562 million and annualizing it to about $2.25 billion. We'll assume an 8% growth rate, which perfectly aligns with their own organic revenue guidance. Then, to account for risk, we discount those future cash flows back to today using a 9% weighted average cost of capital. Essentially, that's just the required rate of return to justify taking on the investment risk. Finally, we assume a standard 3% terminal perpetual growth rate for when the business eventually matures. Take a look at how these assumptions play out in a sensitivity table. If we stick to our baseline, that's a 9% WACC and a 3% terminal growth rate right in the middle, the math explicitly spits out a fair value of roughly $365 per share. You'd only get a valuation of $480 if you assumed a very aggressive 8% discount rate paired with a 4% terminal growth rate. So from a pure fundamental cash flow perspective, the current $408 price is definitely looking a bit stretched. But wait, what if we run a dividend discount model, or DDM, instead? This values a company purely based on the present value of its future dividend payments. If we use their 3.64 annualized dividend, combined with their very impressive 10% historical dividend growth rate, and assume an expected market return of about 10.9%, we actually find a fair value hovering right around $400. This is huge because it's practically the only quantitative model we have that closely supports today's trading price. Finally, Part 6, Synthesis and Final Verdict. Let's bring all these frameworks together.
Lining all these models up side by side reveals a really clear narrative. Benjamin Graham is out entirely at $299. Peter Lynch is super cautious due to the crowded trade and insider selling. Our discounted cash flow base case points to $365, and Warren Buffett, he'd likely target that $350 range just to ensure his required margin of safety. Like we saw, only the dividend discount model, which heavily rewards their 33-year growth streak, really justifies the current $408 price tag.
So as an investor looking at your own portfolio, you really have to weigh these realities. On one hand, you have incredible strengths. We're talking massive cash flow compounding, highly defensible software moats, 11% total revenue growth, and that remarkable 33-year dividend streak. But on the flip side, the risks are heavily tied to a premium valuation, a pretty leveraged balance sheet with $10.6 billion in debt, and company insiders choosing to cash out some of their shares right now. All right, the moment of truth, the final verdict. Roper Technologies is undeniably a phenomenal, highly resilient business, but at $408, it is absolutely priced for perfection. Based on the aggregate of our guru frameworks and quantitative models, we're calling it a solid hold. The prudent move here is to keep this high-quality compounder on your watch list until it drops into that $350 to $365 range. That's where the DCF and Buffett's required margin of safety finally align.
I want to leave you with this final thought. Warren Buffett often compares investing to baseball, but with one major difference. There are no called strikes. You literally do not have to swing at every pitch. So, knowing the math behind all the models we've walked through today, and what exact price does Roper Technologies become your perfect pitch?